All right, let's get right into the numbers. Welcome to today's Explainer, where we're breaking down the absolute latest financials from Protector Forsikring ASA. They just dropped their Q2 and H1 2026 interim report. And look, if you are tracking financial health and market trajectories right now, this is a must-see. We are looking at a high-stakes battle between operational dominance and market volatility. Let's look under the hood to see exactly what's driving shareholder value today. Here's our roadmap for the analysis. First, top-line results and growth. Second, strong core insurance operations. Third, the investment return contrast. And fourth, capital position and dividends. Let's hit it. Section 1. Top-line results and growth. Okay, keep one thing in the back of your mind as we go through this data. This report is a fascinating tale of two drivers. First up, unstoppable momentum. Protector is seeing a massive upward trajectory in premium growth across all segments in local currencies. It's signaling that their market penetration strategies are quite literally firing on all cylinders. Let's look at the hard data. For the second quarter alone, Protector posted a solid 6% volume growth in local currencies. That pushed their gross written premiums up to a very healthy 4,142 million Norwegian kroner just for those 3 months. But man, you mount to the first half of the year as a whole, 15%. That is a massive local currency volume growth for each one. This double-digit surge pushed their gross written premiums to a staggering 10,481 million kroner. Every single segment is contributing to this. As an analyst hunting for catalysts, this kind of rapid, aggressive revenue expansion is exactly what you want to see. Section 2. Strong core insurance operations. Before we check out the numbers, quick refresher on our baseline metric here. The combined ratio, or CR. It is the ultimate measure of profitability for an insurance company's daily operations. Basically, anything under 100% means they're making an underwriting profit. The lower the percentage, the wider their profit margins. Simple as that. And well, these numbers brilliantly illustrate their operational strength. They posted a Q2 combined ratio of 81.5% and an H1 ratio of 83.2%. Not only are these incredibly strong margins, but they're also solid improvements over their 2025 figures. This drove their insurance service result to an impressive 1,243 million kroner for the half year. Operationally speaking, the company is an absolute machine right now. Section 3. The investment return contrast. Now for the dramatic turn, the sheer tension between our two drivers. On one hand, you've got that stellar, record-breaking insurance service profit of 1,243 million kroner. But on the other hand, their total investment return plunged down to just 134 million kroner. For context, last year, that investment number was over 1 billion. Yeah, it's a stark contrast that heavily impacts the bottom line. When you look at the breakdown here, the divergence is crystal clear. Premiums are up nearly 1 billion kroner, and the service result is up significantly. But net income from investments, it fell off an absolute cliff, dropping from 1,219 million in 2025 to just 215 million in 2026. This massive, nearly 1 billion kroner drag in market-driven investment income went head-to-head against their operational success. So, the result of this clash? Total H1 profit landed at 920 million kroner. That is a noticeable step down from the 1,473 million they posted back in the first half of 2025. The core business is thriving for sure, but the market conditions governing their assets pulled the net income down. Section 4. Capital position and difference. So, the big question, how did the balance sheet weather this mixed half year? Well, despite the significant headwinds in the investment portfolio, Protector remains heavily focused on forward-looking stability. They've got their eyes locked on resilience for their shareholders. And the capital metrics absolutely back that confidence up. Their solvency capital ratio, the SCR ratio, sits at a highly secure 221% post-dividends. That's actually a slight tick up from 220% last year. Because of this ironclad solvency, the board authorized a generous dividend distribution of 247 million kroner, which works out to 3 kroner per share. They're actively rewarding shareholders despite the investment dip. Which brings us to the ultimate question for you. How do you personally weigh record-breaking, highly efficient core operations against temporary, market-driven investment dips when evaluating long-term resilience? This report proves Protector can underwrite and grow brilliantly. But, they are still tethered to broader market fluctuations.
think about where the real long-term value lies. Thanks for joining me on this explainer, and keep your eyes on the data.